Welcome to We Are Cosmic, a channel where global finance, cryptocurrency markets, and institutional behavior are analyzed with clarity and logic. XRP, broader changes in the cryptocurrency market, and the actions of significant financial entities that shape price action behind the scenes are the topics that will be discussed today about cryptocurrency. It is not about making forecasts or spreading rumors. It is important to have a solid understanding of what is actually taking place in the market and why it is significant. The cryptocurrency market has entered yet another phase of turmoil that is readily apparent. There has been a significant shift in price. There is a high level of passion, and narratives are shifting more quickly than facts. In these kinds of circumstances, it is essential to take a step back and focus on the structure rather than reacting to the newspaper headlines. Rather from being influenced by consumer mood, XRP, Bitcoin, and the market as a whole are currently reacting to liquidity concerns, macroeconomic uncertainty, and institutional positioning. When this observation was made, XRP was trading close to the $2.7 level, demonstrating a moderate amount of daily strength. On the other hand, Bitcoin was lingering below the 90,000 range after seeing a discernible retreat. These motions are not arbitrary in any way. They are in tight alignment with the behavior of weekly liquidity, the customary opening hours of the market, and the structural gaps that are known to exist in futures markets. Before coming to any conclusions, it is essential to have a solid understanding of this environment. The CME gap, which again became active, is one of the primary factors that has been driving the volatility that has occurred recently. Historically, these disparities have a tendency to close fast, particularly on weekends when there is a diminished amount of liquidity. As was to be predicted, the market fell downward during conditions of low liquidity, and it filled the gap immediately after regular markets reopened a short time later. As a result of the fact that this pattern has occurred multiple times over the past few weeks, it is becoming less of a surprise and more of a structural tendency. The broader market action continues to be choppy and unpleasant, despite the fact that there have been short-term higher surges that have briefly caused excitement. This is a common occurrence during times when the markets are waiting for confirmation from macroeconomic factors. Many investors are exercising caution as a result of the attention on the Federal Reserve. Whenever there is uncertainty around interest rate choices or direction, the cryptocurrency and equity markets have a tendency to hesitate, waiting for clarity before making any financial commitments. Because of this waiting behavior, there is a void in the market which makes it easier to manipulate prices. Large players are able to move markets with relatively less capital as compared to normal conditions because of low conviction and reduced participation because of these factors. It is common for this atmosphere to generate deceptive signals that give the impression of being optimistic or bearish but do not follow through. During the most recent declines, it is also essential to take note that XRP has demonstrated a level of stability that is comparable to that of Bitcoin. XRP has escaped the dramatic downward fluctuations that have been observed in other assets, despite the fact that it is not immune to volatility. This relative strength does not indicate that there will be an instant increase in value. Nonetheless, it does show structural disparities in the way that capital is interacting with the asset. The purpose of this movie is solely to provide educational and analytical content. Providing an explanation of the market mechanics, institutional behavior, and legislative events that are influencing the cryptocurrency environment is the objective of this section. The provision of financial advice is not being made. It is strongly recommended that viewers engage in critical analysis of information and establish their own understanding of danger. As this debate continues, the focus will change to market manipulation tendencies, the conduct of institutions that accumulate assets, the regulatory clarity that is forming around crypto assets, and the reasons why XRP continues to be a part of these broader financial conversations. The recent price behavior of Bitcoin once again brought to light a structure that is well known, a weakening over the weekend, followed by a quick movement once the markets in the United States open. When there is a lack of liquidity, it is simpler to exert financial influence over prices. This frequently leads to movements that are overstated and do not accurately reflect the supply and demand situation. The most recent decline toward the middle of the 84,000 range, which was then followed by a speedy recovery, is closely aligned with the closing of the CME gap. These disparities are a result of the fact that futures markets halt trading on weekends while spot markets continue to operate. When traditional markets are opened again, prices frequently return to levels that have not been traded. The occurrence of this pattern has become more and more predictable. Over the course of the past few weeks, gaps have become smaller, which has resulted in speedier closures, often by the hour. Despite the fact that some market players consider early upward movement to be a sign of strength, the more comprehensive structure frequently reveals that these movements are only temporary and are driven more by positioning than by conviction. Immediately after the opening of regular markets, the selling pressure resumed. There was a brief attempt at recovery for Bitcoin, but it was difficult to maintain higher levels. This pattern of behavior is not exclusive to cryptography. During times of macroeconomic uncertainty, equity markets tend to exhibit patterns that are comparable to one another. There is a chance for manipulation when there is low liquidity. This is because large orders have the potential to push prices into locations where stop loss and liquidation levels are concentrated when there are fewer participants actively trading. A cascading effect is produced as a result of this, which in turn amplifies motions that appear organic but are actually structurally engineered. It was during this time period that XRP's reaction was more subdued. Despite the fact that the price did move, it did not experience the heavier retracements that Bitcoin did. The fact that this is the case implies that the selling pressure was not distributed evenly across the market, and that significant players are treating certain assets in a different manner. The fact that this kind of market activity does not suggest long-term weakness is an important point to note. A market that is waiting for macro direction is reflected in this. There is frequently an uptick in volatility during Federal Reserve weeks, but there is no discernible pattern formation. When these physics are understood, it is easier to differentiate between noise and structure. The movement of markets is not accidental. They react to liquidity, timing, and incentives in any given situation. When these factors are in proper alignment, the behavior of prices becomes more predictable, despite the fact that it appears chaotic at first glance. The recurring sell-off that takes place shortly after the opening of the U.S. market, typically around 10 o'clock in the morning Eastern Time, is one of the trends in recent market activity that has received the most attention. The timing of this event is not a coincidence. This is in accordance with the peak liquidity and the participation of institutions. Firms that specialize in high-frequency trading are the ones that take advantage of these windows. They are able to drive prices into liquidity zones, cause reactions, and then re-enter at more favorable levels since they execute enormous volumes at a high pace. This procedure is repeated on a regular basis, which gives the impression of everyday frailty. Upon closer inspection of the chart of Bitcoin, the pattern becomes increasingly difficult to ignore. Rather than being the result of emotional selling, sharp dips quickly after the opening are indicative of mechanical execution, which is followed by delayed recoveries. This behavior is highly consistent with the tactics that are commonly employed by major quantitative companies. There are reports that imply that one of these companies has a significant position in exchange-traded funds, ETFs, related to Bitcoin, including exposure through BlackRock products. The implication here is that accumulation is more likely than dispersal. In this scenario, price declines serve a functional purpose rather than suggesting that gloomy outlooks are likely to occur. This presents a challenge to the prevalent narrative that the weakening of Bitcoin is solely driven by fear of the macroeconomic environment. Although macroeconomic considerations do play a part, it seems that execution techniques, rather than fundamentals, are the primary drivers of a major chunk of the short-term movement inside the market. It is common for market behavior to shift after accumulation phases have been completed. There is a decrease in volatility, there is a drop in selling pressure, and the price starts to stabilize. Due to the fact that this change takes place in a peaceful manner, without any big headlines, it is frequently misunderstood. A shift in viewpoint occurs when one comprehends the functioning of institutions. There is no guarantee that a decline in price indicates a loss of trust. There are several instances in which it reflects strategic posture during times of macroeconomic uncertainty. One of the most remarkable achievements that XRP has accomplished is becoming one of the crypto spot ETFs that has surpassed $1 billion in assets under management in the shortest amount of time. Because of this accomplishment, XRP is now considered to be on par with other significant digital assets that have successfully transformed into publicly traded financial instruments. Because of this increase, there is a significant need for regulated cryptocurrency exposure. There is a preference among many participants to gain access through well-known financial structures rather than through direct interaction with blockchain technology. exchange-traded funds, ETFs, eliminate technical hurdles, and minimize the perceived risk of investing. The availability of digital assets is expanding to a much wider audience as a result of the opening of access to crypto products by large institutions through retirement and brokerage accounts. When it comes to short-term volatility, these participants frequently place a higher priority on longevity, compliance, and brand awareness. Another factor that contributes to this view is Ripple's corporate presence and valuation. Instead of relying on speculative tales, institutional investors frequently evaluate assets based on the organizational backing, regulatory posture, and long-term viability of the asset. Despite the fact that this does not ensure price performance, it does explain why XRP continues to garner attention within frameworks that are regulated. During this stage of market evolution, it is important to look at things like stability, infrastructure, and existing financial relationships. The environment for tokenization has been made more transparent as a result of recent regulatory developments. It is a symptom of a shift in regulatory stance that the Securities and Exchange Commission, SEC, has decided to conclude an investigation that has been going on for a long time into a company that focuses on tokenization. The conclusion that many of the past enforcement operations were exploratory rather than decisive is supported by this outcome, which reinforces the larger narrative. The level of uncertainty in the market begins to decrease when cases are resolved without any penalties being imposed. Significant institutions continue to show a significant amount of interest in tokenization. There is a rising confidence in this industry, as seen by partnerships that involve asset managers, blockchain companies, and providers of financial infrastructure. It is not possible to minimize danger entirely, but clarity does lessen ambiguity. In spite of the fact that the rules are restrictive, markets react favorably when they are made more transparent. There are times when uncertainty is more detrimental than regulation itself. On the topic of cryptocurrency market structure, major banks in the United States are now interacting directly with lawmakers. A shift in strategy, rather than a change in ideology, is reflected here. Classical institutions have come to the realization that ignoring cryptocurrency is no longer a feasible option. It would appear that banks are concentrating on integration rather than competing with the market. They want to achieve their goal of shaping regulatory frameworks that allow participation without sacrificing relevance by taking part in regulatory talks. This is a reflection of prior actions taken by asset managers who opted for adoption rather than resistance. There are already several institutions that have demonstrated that early integration has been financially viable. There is a little probability that banks will allow decentralized alternatives to completely replace them. Nevertheless, cooperative efforts, settlement services, custody, and the integration of infrastructure are all potential avenues for progress. When it comes to the future of finance, it is more likely that cohabitation will prevail over replacement. As opposed to being in direct competition with one another, traditional institutions and blockchain systems are heading toward positions that overlap more.